Hyperliquid just hit a $10 billion market cap, officially surpassing Cardano in the global rankings, and is already up 225% on the year. But price action is only a symptom of a much larger structural shift happening in the decentralized finance sector. While most retail traders are obsessing over arbitrary price targets, the underlying data shows that this protocol is quietly capturing 83% of the entire decentralized derivative sector revenue. It's not competing, it's monopolizing. Today, we are going to look past the social media noise. We are going to analyze the verifiable on-chain data, break down the critical levels on the daily chart, and outline exactly how I'm managing my current position. If you want to understand why institutional capital is aggressively rotating into this specific asset, you need to see what the charts and the fundamental metrics are telling us right now. Right now, the token is trading around $38 to $40. For those who have been following my analysis, you know we had a phenomenal entry around $30 just 3 weeks ago. The market sentiment is understandably euphoric at these levels, especially with the sudden surge in geopolitical trading volume pushing the platform's annualized run rate to $600 billion. People are getting greedy, and when the crowd gets greedy, our job is to remain incredibly objective. This video matters today because we are currently sitting directly between two major technical zones. We have secured our early profits, but the structural trend is still heavily intact. However, there's something in the technical data that suggests we might see a short-term cooling-off period before the next major impulsive leg up. We need to bridge the gap between the massive fundamental catalysts driving this volume and the specific technical levels that will dictate our next strategic move. It's very easy to buy a breakout. It's much harder to manage the risk and compound the yield once the breakout has occurred. Before we look at the daily chart, you have to understand the foundational mechanics driving this capital rotation. Hyperliquid is executing what essentially amounts to a systemic vampire attack on both centralized exchanges and traditional finance. Let us look at the fiat onboarding infrastructure. Hyperliquid recently integrated direct credit card and bank transfer deposits with a 0% fee structure. This completely removes the primary friction point for retail capital. Users no longer need to buy stablecoins on Coinbase or Binance and bridge them over. They are capturing first-time deposit flow directly, fundamentally threatening the business model of centralized giants. This infrastructure is supported by a localized stablecoin supply that has grown exponentially, now sitting at $879 million. That deep liquidity is the lifeblood of the ecosystem. It allows for massive institutional order books without the risk of severe slippage. And we are seeing that liquidity put to use through extremely high triple-digit annual percentage yields. Right now, providing liquidity on Solana pairs is yielding over 95%, and USDC pairs are pushing 129%. These yields are a magnet for mercenary capital, incentivizing users to lock up the token, which inherently reduces circulating supply volatility. But the most significant catalyst is their expansion into traditional assets. Hyperliquid secured an exclusive partnership with S&P Dow Jones Indices to launch the first official S&P 500 perpetual contract on-chain. When Wall Street closes on Friday afternoon, traditional markets freeze. Hyperliquid doesn't. Over the past 3 weeks, real-world asset trading on the platform has repeatedly broken records, surpassing $1.3 billion in open interest and $1.4 billion in weekend volume. Traders are actively front-running macroeconomic and geopolitical events on-chain while traditional finance sleeps. The result of this localized liquidity and exclusive market access is total dominance in user engagement. We are looking at 69,000 daily active users, which equates to an 85% market share over their nearest competitors. This is not phantom volume from a handful of wash trading whales. This is sticky, organic user adoption. Over the last 90 days, they have processed over $740 billion in volume. That 52% volume market share translates directly into $173 million in real revenue. They are a cash flow machine, and that revenue validates the $10 billion valuation completely.
Now, let us transition to the daily timeframe chart and see how this fundamental dominance is reflecting in the price action. Look at the broader market structure. We are going to anchor our Fibonacci retracement from the macro high of $59 back in September of 2025, dragging it down to the ultimate base level of $20, which was established as a double bottom between October 2025 and January 2026. In late January, we saw the first major signal. Price broke out of a multi-month descending trendline with a massive 24% green expansion candle. That breakout initiated a rapid 50% run. Following that impulsive move, the market needed to digest the gains, forming a very clear falling wedge pattern over a 3-week period. As you know, we identified the breakout of that falling wedge exactly 3 weeks ago on March 2nd, which is where we executed our core position entry at $30. Currently, price is trading precisely between our two most critical Fibonacci levels. Our primary support rests at the 382 Fib level, located at exactly $35. On the upside, our immediate resistance is the 618 Fib level at $44. We have already seen a sharp rejection at that $44 zone, which aligned perfectly with my second take-profit target. If we look at the momentum indicators, specifically the Fibonacci Relative Strength Index located below the main price action, we can see that it's deeply overbought. The oscillator is currently pointing downward. While an asset can remain technically overbought for extended periods during a strong trend, it indicates that the current move is stretched. The momentum is decelerating, which supports the thesis of a near-term consolidation phase. This brings us to our moving averages, which are the absolute core of trend identification. The price is currently trading well above the 21 exponential moving average, represented by the red line, and the 200 simple moving average, represented by the green line. For our newer viewers, it's important to understand the distinction here. Exponential moving averages apply more weight to recent price action, making them more responsive to current volatility. I personally utilize the 10, 21, 55, and 100 exponential moving averages to track short to medium-term momentum. However, for the macro trend, I strictly use the 200-period simple moving average. The 200 is the gold standard across all global financial markets. It's probabilistically respected as major structural support or resistance far more reliably than an exponential average on the higher timeframes. I intentionally keep my charts clean for these videos, only displaying the specific averages that are actively interacting with current price action. Right now, we are watching a highly bullish technical signal unfold, as the 21 exponential is crossing aggressively above the 200 simple moving average. So, how do we trade this data? I explained my exact strategy for my private community earlier today, and now I'll share it with you to show the kind of alpha I'm giving them. After hitting our targets at $35 and $44, we are seeing the expected consolidation. Huge impulsive moves almost always require a pullback to retest the 21 exponential moving average. If you are currently sitting on the sidelines, a retest of the $35 to $37 region provides a highly logical re-entry setup. This zone aligns perfectly with the 382 Fib at $35. Entering here carries slightly more risk than our initial $30 entry, but it's a mathematically valid setup if you strictly control your downside exposure. If you take that trade, in my opinion, your hard invalidation level should be a daily candle close below $34. Don't front-run the level. Only allocate capital if the price actually comes down to test that specific liquidity zone. If you want to see exactly how I execute these setups in real time, it might be time to step into the Pro Capital Vault. This is my private Discord community, accessible directly through the YouTube members program on my channel. It's built for serious position traders who want to move beyond basic analysis. You get my exact buy and sell zones, real-time portfolio tracking, a comprehensive Sunday prep report, and weekly live strategy calls. It's a strictly professional environment focused on risk-adjusted returns. Just click the join button below this video or use the link in the pinned comment. Once you join, simply sync your YouTube account to Discord, and it'll automatically unlock all the private channels.
Now, returning to the strategy, my current trade management is focused entirely on capital preservation. My trailing stop loss has been updated to $34, strictly waiting for a daily close to trigger. If that level breaks and I'm stopped out, I take 20% of those realized profits and immediately move them into my long-term spot bag. Fundamentally, this asset is a beast. They are consistently burning more tokens than they mint, the revenue is undeniable, and the traditional finance adoption is accelerating. Our upside targets remain clear. The immediate hurdle is clearing that 618 resistance at $44. Once we secure a daily close above that level, the structure opens up significantly, placing our next major macro targets at $60 and $83. As we hit each successive target, the stop loss moves up to the previous target level to lock in guaranteed yield. To summarize the thesis, Hyperliquid is fundamentally dominating the decentralized derivatives market with an 83% revenue share, while technically consolidating between $35 and $44 in preparation for its next structural move. The data suggests patience here. Let the chart come to your levels, protect your capital with strict invalidation points, and never let a green portfolio turn red simply because you refused to take profits at major resistance. If you found value in this data-driven approach, please hit the like button and subscribe to the channel. I highly recommend watching my previous video on Hyperliquid from March 2nd, as it breaks down the exact psychology behind our initial entry at $30. Remember, none of this is financial advice. This is simply my personal read on the macroeconomic environment and the technical data. Manage your risk, protect your yield, and I'll see you tomorrow in the next video.